Good evening, folks, and thanks for joining us. This is our latest webinar offering financial advice in a sort of a relaxed evening session. And the idea today is really to talk about what you can do. That should actually, it says pensions for self-employed. That shouldn't be actually. So we're talking about public sector, guys, and the idea around this is we've been in advising public sector employees for a long number of years, and the demand on that advice has got a lot. It's a bigger demand, and people are looking for more advice on it. And we decided, listen, let's have a dedicated service that we can actually bring in a professional that has been doing it for years. And thankfully, Ruth has joined us, and that's why I wanted to introduce Ruth today to our own customers and to anyone that's actually joining us. You're very, very welcome. For those that don't know who we are, we're Advice First. We've been advising clients since 1992. Advice First itself started in 2005. We do a broad range of financial services. So today we're introducing you to the public sector pensions, and the idea here is, guys, that we're offering value added in a non-union attached way. So it's about independent advice. It's about giving you choice. It's also about giving you an independent voice in this. So as I say, my name is Pascal Curran. I've been in the financial services since 1992. We've been advising public sector for that length of time. Ruth thankfully joined us last year, and Ruth came in to basically head up this particular advice service that we want to give. And we wanted a dedicated service because it is very, very important that you take independent advice when you're planning your financial future. And that's really what we wanted to do. So Ruth is going to lead the presentation today. She is the expert in it. She's here to answer all your questions. So, guys, use her. It's not very often you get a chance to have a session like this. So, by all means, send in your questions to us. We will get to them. You can do that by raising your hand. I'll unmute you. You can also type in your question to the text box, and we will get to your questions. We're going to run, guys, to about quarter to 8. Now, if the session is lively enough and you want us to answer more questions, we have no problem, but we'll aim to be finished at quarter to 8. So guys, hopefully you enjoy the session, and if you have any questions when we're finished, by all means, come back to us. So Ruth, I'll hand over to you and you can work away, hopefully, if I've done that right.
Yeah, I'm in control now, am I?
I hope you are.
I don't appear to be.
You seem to be. There you go.
Let's have a look now.
I think you have it, Ruth.
Okay. If I click too fast now, we'll be at the end of the presentation before we've even started. So look, thanks to everybody that's taken the time to come online tonight. I suppose just with regards to the questions, if people have questions, if they keep them to a general nature, any specific questions at the end of the presentation, Pascal is going to be sending around an appointment questionnaire for those of you that want to avail of the private consultations, which I would encourage you all to take up the offer. But that's where we will really address the individual questions, excuse me. So look, the agenda for the next half hour is to go through your main scheme benefits so that you hopefully get a good understanding by the time we're finished the presentation. I know from speaking to a lot of public sector employees, they find the main scheme, understanding their main scheme benefits is a bit like trying to assemble IKEA furniture. It can be absolutely mind-boggling. So I suppose my goal for this half hour is to just explain it in the most simple terms I can, and hopefully you'll have a really good understanding of what it is, what your scheme will benefit you. So look, the options that are available to civil and public sector staff to boost their entitlements, so we'll go through those options. Safeguarding your income against all possible risks. So we'll be talking a little bit about income protection and your death and service benefit. And then understanding AVCs and determining the best fit for you. So as Pascal mentioned earlier, we're not affiliated with your union or your employer. So, we're giving unbiased advice on AVCs. And we'll talk a little bit about the group AVC versus taking out a PRSA AVC privately. So what we're going to look at is what happens if you get sick. So look, during your 40-year career, possibly your career is going to span 40 years. It's highly likely that we're going to get sick at some stage and not be able to work. What happens if you actually want to retire early? So you may not have plans to work up till 65 or 70 for the new entrants. You might want to get out a bit earlier. So we look at that. We'll also look at what happens to your spouse and your children if you die in service. What's there to financially support them. And also you, please God, you make it to retirement, and what's going to happen to your income when you eventually retire. So we're going to look at all eventualities, okay? So your ill health benefits. So we look at the ill health benefits first, because as I said, it's highly likely that during our career, we're going to get sick at some stage. Hopefully not for too long, but if it happens, it's really important for you to know what it is you're going to have. The good news is that your employer has some really good benefits in place for you, but they're not forever. They do come to an end at a certain time. So if you get sick, I'm using, just for tonight's explanation, I'm going to use a salary of 50,000 euros for all of my explanations, because it's a nice round figure and it's easier for me to explain. And it's late in the evening, so I don't do too well late in the evening. So 50,000 euros, we're going to assume you're all earning 50,000 euros, okay? So if you get sick, you get paid full pay for 3 months, and then it drops to half pay for 3 months. So you go from earning 50 to 25. And then if you still can't return to work after 6 months, then you're onto the state disability benefit. Now, some important things to note here is that your ill health pay is based on a 4-year rolling period. So if I got sick today, the first thing my employer will do is look back 4 years. They'll check to see if I've been sick in the last 4 years, and that'll be deducted from my 3 months full pay. So just be really mindful that if you've been sick in the last 4 years, you may be onto half pay a lot sooner than you think. Now, up until 2014, the ill health benefits with the public sector was actually 6 months full pay and 6 months half pay. So they've been reduced by 50%. So it's something for you just to be mindful of. So if, let's say, you are sick and you cannot return to work, there is an option to retire early on ill health early retirement. So if that was to happen to you and you were to retire, if you have less than 10 years of service and your employer deems you unfit to return to work, then what will happen is if you have less than 10 years of service, your service will be doubled. If you've got between 10 and 19 years of service, they'll bring you up to 20 years of service. And above 20 years of service, they'll add on 6.6 years to whatever service you have at the time. Now, if, let's say, you've got 35 years service, they're only going to add on 5 years. Bear in mind, your entitlement to the pension and the ill health benefits is capped at 40 years of service. So look, if after, as I said, if you get sick and you can't return to work, there is something called temporary rehabilitation remuneration. And I can't believe I got that right first time around. Temporary rehabilitation remuneration. But it has to be approved. And basically what that is if your employer thinks that you could return to work. So they're kind of saying, well, look, they've been out sick for a long time now, but possibly they could return to work. Then what they can do is put you on 37.5% of your salary, and that's your grade salary. It excludes overtime or any other allowances you have, and they can pay you that for a period of 18 months in the hope that you can return to work. So look, there's a couple of different options there, but generally with the sick pay, the majority of people are going out with the likes of, post-surgery recovery. They're going out with mental health issues is a big one. And then, things like arthritis, joint pain, back problems. Those are the main reasons, and obviously cancers, but those are the main reasons why people are going out. And unfortunately, the ill health early retirement would not cover that or TTR, just maybe the cancer one. So income protection. So what is income protection? Now, a couple of people actually emailed me before the presentation and asked me to include this because a lot of people are looking at income protection now as a way of, ensuring that they have a really good foundation for their future financial plans. And if you think about income protection like building a house, if you were to build your house on sand, then it's not going to last very long. But if you build your house on a really good solid structure, then your house is going to withstand absolutely anything, even Storm Eowyn, by the way. So it's going to be, a really good long lasting structure, and income protection is the same. Having income protection really should be your first port of call when it comes to financial planning, because if you get sick and you cannot go back to work and your income stops, everything else is going to stop. Your mortgage repayments, and you're certainly not going to be making AVC or pension contributions. So look, what is income protection? It's basically provides you with a regular income up until such a time as you can return to work. Or if you are out long-term sick, it provides you with an income up until the day you retire. So what that means is that if you got sick and went back to work and then you were out sick again and went back to work and went out sick again, it pays you no matter how many times. There's not a clause there that says, look, you can only claim once. If you're in and out of work due to ill health, it's going to continue to pay you until you can return to work. The conditions are covered are, basically everything except pre-existing medical conditions, and it doesn't cover you for redundancy. So everything else you're covered for. So obviously it's important to declare any pre-existing medical conditions so the underwriters can, advise you whether you're going to have exclusions on your income protection. But it certainly doesn't mean that you won't get income protection. The big thing around the income protection is it's affordable for the majority of people, unless, you're looking at absolutely massive income protection, but it's fully tax deductible at your marginal rate. So if you're on the 20% tax band or on the 40% tax band, it's fully tax deductible. So, it's really a worthwhile investment because you're investing in your ability to get up every day, go to work and earn an income. And I think, that investment alone is one that everybody should be putting money towards. And look, it provides you with peace of mind as well. So it reduces your stress because if you're sick and you're out of work, you really don't want to be stressing about having to return to work. And it helps you meet your most essential expenses as well, okay? So as I said, look, it allows you to recover without stress, putting stress on your relationship with your spouse or your partner, putting stress on the family. So, having income protection, you can adjust what the waiting times are. So as we said in the previous slide, you're paid for the first 26 months. Some of you may have a spouse or a partner that you think that they should be paying income protection, which is always wise if you're in a relationship that both of you ensure your incomes. So you can decide, whether you want the salary protection kicking in after 13 weeks when your income drops to half pay or 26 weeks after your 6 months paid leave. For a spouse or partner, look, you might want to kick in a little bit sooner if they don't have similar benefits to yourself, which in the private sector, a lot of people don't. Okay. Any questions so far, Pascal?
Ruth, we'll just carry on because I don't want to touch the screen in case I mess it up. We'll just keep,
Yes.
we're doing well
Good
on the
idea.
tech, Ruth. We're good financial advisors. We're bad technicians when it comes to
Oh,
tech.
God.
So
Yeah.
we'll keep going. We'll deal with the questions when the presentation's over, guys. if
When
that's
it's
okay.
over. Okay. Well, I'm actually amazed I'm still in control of this screen. So yes,
So
good
am
idea.
I. That's why we're going to keep going.
Hands off. Okay, look, so we've touched on what happens if you get sick. So what happens if you die? Because look, if you die in service, that's the end of your income. It's the end of the income for your spouse, and it's certainly the end of the income for your children. So you do have a death in service benefit with your employer. Basically, the way it works is if you have less, excuse me, than 20 years of service, then your death in service benefit to your spouse is going to be 1 time your salary. So 1 year's salary. If you've got more than 20 years of service, it's 1.5 times salary. Now, if you're a post 2013 entrant, so you're on the single pension scheme, which is anyone that joined after 1st of January 2013, if you've less than 2 years of service, it's a refund of your superannuation contributions and your additional superannuation charge or contribution charge. If you've more than 2 years of service and you're a new entrant, it's 2 years salary. So look, I think in anyone's books, if you were to die tomorrow and your spouse or partner had 1 year's salary to live on or a maximum of 2 years salary to live on, that's going to cause major financial problems for your spouse, partner, children. So it's really important for us to be able to stress test with you in the one-to-one consultations, stress test these benefits that you have in the event of death. Some of you may have already taken out insurance with your mortgage or taken out life assurance with a bank. So let's look at it. Let's stress test it against what you have in place already, in addition to what you have privately, and see, is it sufficient? And if it's sufficient, fantastic. There's nothing more you need to do. But there's absolutely no point in finding out it's not sufficient on the day of your death when your spouse or partner has to manage financially on 1 year's salary or 2 years' salary. So look, on to cheerier things, spouses and children's pension scheme. So Look, there is good benefits in place with your employer. So the spouses and children's pension scheme, this is a payment that you are all making, okay? You don't see it, a lot of you don't see it on your payslip because it's just masked in your other contributions, your other superannuation contributions, should I say. But you're all paying into spouses and children. So all men definitely pay into it. Anyone that joined the civil and public sector before 1980 had an option. Women had the option to come in or go out of it. And if you're out of it, you can't get in. If you're in it, you can't get out. But anyone that joined after 1980 is definitely paying into spouses and children. So in the event of death, they get a lump sum, as I said, as I explained on the previous slide. And then they would also get, the spouse would get half of your pension paid to them for the rest of their life. So if you were due to get 500 euros a fortnight, they'll get 250 paid for the rest of their life. Your children are entitled to 1/6 of your entitlement. So in the example I gave, 500 euros, they'd be entitled to 1/6 of your pension entitlement. It's paid to your children up until 16 years of age, or if they're in full-time education, it pays to 22. Now, if you have a a permanently incapacitated child, it will be paid to them for their life, okay? So it's treated the same way as the spouse's pension. And it's capped at 3 children. So if you have more than 3 children, you just need to pick your 3 favorite kids because it's capped at 3 children, okay? So as I said, it's a compulsory payment. There's no opting out of it. So look, it's a bone of contention with a lot of people. Some people feel, you know, they're single, they're not married, and they've no intentions of having kids or getting married. But look, it's just compulsory. It's not an opt out. So your pension benefits. So I suppose, look, this is really where most people want to know what is my pension going to be? So look, you haven't got sick. You're still with us, you haven't died. So you make it to retirement. So what is it that you're going to get? Well, look, the key points to note about your pension is who will pay your pension, when will it be paid, how will it be calculated, and how much are you going to get when you get to retirement. So the important thing to note is when did you join? And that's going to determine all of those. That's going to answer those questions for you. So there's now 4 pension schemes in the public sector. There's the pre-1995, the post-April 95, the post-2004, and then the newest one, which is the single pension scheme. So I'm going to go through the 4 different schemes. So if you're pre-1995, you are by far on the best pension scheme that there is in the public sector. Because after April 1995, this is when all the reductions came into force. So what I'm going to do is talk you through the 4 different pension schemes that are now in the public sector, okay? So what scheme do you fall under or into? Or so again, I'm using an assumption of somebody earning 50,000 euros. They're going to have their full service at retirement at 65. So full service, again, just to reiterate, full service is 40 years. So when did you start? So if you joined before April 1995, so let's say, for example, I am retiring tomorrow. I earn 50,000 euros. When I wake up tomorrow, my income will be 25,000 euros. So at best, my income has dropped by 50%. Now, if I'm pre-1995, then I can retire from 60 onwards and take my pension and lump sum, which is 1.5 times your final salary is the maximum lump sum. And if you want to retire early, which a lot of people are looking at this now, I'm actually surprised at how many people are querying early retirement. You can take your pension benefits on a cost-neutral early retirement, which is the CNE or cost-neutral early retirement basis from 50 onwards. So look, it's certainly not cost-neutral for you because it works out at about 5% for every year you take it before 60, and that's 5% reduction in your pension. Doesn't hit your tax-free lump sum as hard, but the income, the fortnightly income, it's quite a big reduction. So if you joined after 95, but before April 2004, so the big change that came into force here is that the government brought in an introductory pension scheme. So what that means is your public sector or superannuation pension scheme is now integrated with the contributory state pension. So you're going to get two pensions paid to you from two different sources at two different times. So imagine this. You are earning 50,000 euros today and you retire, having worked 40 years. You retire tomorrow, your income has gone from 50,000 euros to 9,970. In anyone's books, that's a big drop. Now, the problem with this scheme, this post 1995 pension scheme, is the reason you have a drop in your pension is because you're integrated with the contributory state pension. So you are now going to have to wait until you become eligible to claim the state pension, which is currently 66 years of age. So you can claim your main scheme pension from your employer at 60. You can still go early if you want to, which just widens the gap until state pension kicks in. Your tax-free lump sum is the same. Okay.
Just a very quick question on that one.
Yeah.
A lot of people ask me, well, how do they fund themselves between the age of 60 and 66 until the state pension become eligible for that? And obviously the answer is that you have to go into job seekers, which in itself can cause a bit of a problem as well. So it's an important one, guys. If you are in that bracket and you are thinking about retiring early, there is a gap in your income that the likes of AVCs could make up for you. So it's important just to understand that. And that's a very important point. Sorry, Ruth. Sorry for interrupting you.
No, absolutely. And look, because I'm talking and I'm literally just concentrating on the slide in front of me, absolutely do chip in and help me along. No problem at all. But I'm going to be getting to how you can fund that gap basically in the next couple of slides. So just bear with me for a moment. So after 2004 up to the 31st of December 2012, we basically, look, all the entitlements are the same. Nothing has changed except when you can get your pension from. So if you go out on cost neutral early retirement, it's now 55 and they've pushed your retirement age out now to 65. So that's the only change there, but it's a big change because now, a day in the difference has basically meant, you can retire from 60 yesterday, but you didn't get in on time. You joined the following day. And your colleagues that are pretty much on the same scheme as you, bar one day, you have to work an extra 5 years. So just bear that in mind if you're looking at, what it is you can do to bridge those gaps. Pascal is right with the job seekers. There's a lot of people ask me about a supplementary pension from their employer also if they retire. But what has happened now is that you're now allowed to work up to 70 and still accrue pension benefits for anyone that joined after 2004. Your employer now allows you to work up to 70 years of age and still accrue service. If you joined before 2004, you can work up to 70 if you want to, but you're working purely for income. You don't accrue any service after 65. So for those of you that joined after 2004, you can work up to 70, excuse me. Which I'm sure is not good news to most of you because I certainly wouldn't be working up to 70 years of age. You'd have to wheel me in. But, so you can work up to 70. Look, if you have to, not if you want to, if you have to and you can't afford to retire, you can and accrue more service. So for the single pension scheme, which is the post 2013 entrance, this is a completely different ballgame altogether. You guys are on what's called a career averaged pension scheme. And basically what that means is that if you joined before the 1st of January 2013, everybody that joined before that date is on a final salary pension scheme. So I started on 20,000, I finished on 50, my employer will use 50 for my pension and lump sum calculations. If I joined on the 1st of January or after, then my employer, I started on 20, let's say, and through promotions, pay awards, whatever it may be, I finish up on 50. My employer will not use the 50. They'll use an average of what I earned over my career. So we don't know, obviously we don't know what that's going to be because we don't know, what your future holds and will you go for promotion or will it be grade changes that gets you up the salary scales. But for whatever reason, I'm using an example for the post 2013 entrance of 40,000 euros. So if you earn 40,000 euros on average over your career, then your income is now 9,280. It's dropped from 50 to 9,280. The contributory state pension age. So for the post 2013 entrance, your retirement date is not a set date. I'm sure you know yourself because you will have looked at your contract. But some of them state 68 and some of them state 70. And really what that means, it becomes payable when the state pension, when you become eligible to claim your state pension. Okay, so at the moment that's 66. But for the post 2013 entrance, your contract generally states 68 or 70. Earliest you can go then is 55. And as you can see there, you're not entitled to the same tax-free lump sum, even though you have your 40 years of service. And the reason that is because they're using an average of what you earned and not your final salary. So look, for anyone that joined after 1995, the AVCs are going to be really important for you because of this integration. They're still very beneficial for the pre-1995 people, but it's on an individual basis. So let's take a look at what happens if you don't have your full 40 years of service. So look, you're going to know if you don't have your full 40 years of service, you're going to know the reasons why. And for the majority of people, it's due to unpaid maternity leave or career breaks, or, they might have come in a bit later into the service, or they might be working a bit of part-time work and not, while the kids are young or whatever it may be. The amount of people that say to me, I'm going to go back working full-time my last year of service. I'm part-time now, but I'm going to go back working full-time. And I suppose their way of thinking is that the pension will be based on their full-time salary. But it's based on your full-time salary anyway. So if you're currently job sharing or working, let's say, reduced hours, your employer will base your pension and your lump sum on your full-time salary anyway. Where you're losing out is in the service. So if you worked 40 years and you only worked, a 2.5-day week or 2 days on, 3 days off, whatever it may be, on a rotating basis, then your service is what is getting reduced, not your salary. Okay. And if any of you out there are trying to put yourself forward for promotion, do it within 3 years of retiring. Because if you do it within 2 or 1 year before retirement, they will not accept that salary for your pension. So do it 3 years out from retirement. Okay. So what happens if you don't have full service? So as I said, in the assumptions here, I'm still using a salary of 50,000 euros because that's your grade salary. If you were full-time, that's what you'd be getting paid. But in this example, I'm only using 20 years of service because you've worked 40, but you job shared for those 40. Okay, so everything is pretty much the same, but as you would expect, all of my benefits have now halved. Okay, so if the previous slide, retiring on 25, a drop from 50, or just under 10,000 euros, a drop from 50 was scary enough, then, you're looking at quite a substantial drop from earning 50,000 euros down to 12.5 or just under 5,000. So again, for the post 2013 entrance, tax-free lump sum is not going to be the same because they're going to use an average of your earnings over your 20-year or 40-year career, excuse me. So look, what are the options available to you to boost your lump sum and indeed your pension? So there's a couple of different options that are available to public sector employees. The first one is what's called purchasing notional years of service. This used to be really, really popular. Like when I started back in the industry back in 2005, purchasing notional years of service and AVCs, I would say, were pretty much head on head for options for civil and public sector staff to boost their pension and lump sum. I don't really hear of too many people purchasing notional years of service anymore. And I'll go through the reasons why in a moment. So the other one is, just to go back to purchasing notional years of service, it's basically purchasing years of service from your employer that you cannot work because you don't have the time. So for example, I want to retire at 65. I'm only going to have 35 years of service. You go to your employer, they give you a figure to buy back 5 years of service, and you retire with your full service at 65. Okay. I'm going to go into that a little bit more detail on that, okay? Check with your employer if you're entitled to professional added years of service. So professional added years of service, first of all, it's not applicable for post 2013 entrants. They've completely done away with professional added years of service. But if you're a professional grade in the civil or public sector, let's say engineers, architects, you may be entitled to professional added years of service from your employer, and they can, can be an extra 5 years of service that they'll add on. If you're an older entrant, it can actually go up to, maximum of 10 years of service. So if you're professional grade in the civil or public sector, check with your employer if you're entitled to professional added years. Anything that's going to add to your income in retirement, it's really important that you find this out, way before you retire. And because your employer, it takes them a long time to get you this information. For anyone that's approaching retirement, you'll know what I'm talking about. It can take a year for your employer to give you an estimate of what it is you're going to be getting from your employer with regards to pension and lump sum. So, find out way before you're due to retire. So purchasing student or temporary years, look, it's not applicable to everybody, but if you work in the HSE and let's say you came in, so it applies a lot to nurses. So if you worked in the HSE and you came in as a student, or let's say you were doing, your training or whatever it may be, and you weren't paying superannuation, definitely go back and buy those years of service back. It is relatively inexpensive to buy those back, and it is definitely worth your while. Anything, as I said, that's going to add to your income in retirement, it is worthwhile looking into it, okay? Because once you've retired, believe me, there's nothing more that you can do. AVCs. So look, AVCs, basically additional voluntary contributions, is an option that's open to everybody in the civil and public sector. And I'm sure you already know about it. You would have heard about them. You would have colleagues that pay into them. So it is an option for you. But I just want to very quickly touch on the purchase of notional years before we go into the AVCs. I'm not going to spend too long on this because purchasing notional years, as I said, is really, I just don't hear very much of it anymore. But it may make better sense for people on the pre-1995 pension scheme to buy years of service because their pension is not integrated with the contributory state pension. For the post-1995 entrants, what you buy back from your employer is integrated with the state pension. So, state pension kind of fluctuates on a budget by budget basis. So what you're buying back, we don't 100% know what it is, the value to you is what you're buying back. But it's kind of been diluted a bit because of this integration since 1995. And the cost of buying back years of service includes the spouses and children's pension scheme, regardless of whether you have a spouse or child. So it might not be a good fit for you. And then if you want to retire early, it's not possible. You can't buy years of service to retire before your normal retirement age. So, and then look, obviously for the single pension scheme entrants, the post-2013 entrants, we just don't know what it is that you're buying back because we don't know what your average salary is going to be. So what happens if you did want to buy back years of service, your employer holds the money in the background. And when you get to retirement, then they will determine how much service that will buy you back. So for me, it's, it wouldn't be something that would appeal to me. But look, it's an option and I can certainly go through it with you if anybody is considering purchasing notional years. And then because of increased life expectancy, it is costing a lot more to buy back years of service. Okay? Because obviously the benefit has to be paid to you for longer. So AVCs. So an AVC is an additional voluntary. So voluntary is the word there. You don't have to join them. They're completely voluntary. Additional voluntary contributions that you can make, that you can pay into to boost your main scheme pension. So Pascal was saying there, well, look, if I did retire at 60, what'll happen to my income between my retirement and claiming the state pension? And as I said, your employer has pushed the retirement age out to 70 now for those that want to work up to 70. So it's highly unlikely that they're going to be still paying supplementary pension schemes in the future. I know of a few people that have got them. If they retired at 60, they claimed job seekers, for 9 months. And then the employer paid maybe a 3-month supplementary pension, but certainly not for 6 years. But look, again, nothing is set in stone, so it's something you'd have to discuss with your employer. So AVCs are flexible contributions that you can make to your main scheme pension. You can increase them, decrease them. It's not a fixed or, contracted payment that you're making. That is up to you. And you can maximize your AVCs by paying in lump sums for the previous tax year. So I can make a lump sum payment for last year and I can get a tax tax back on that lump sum based on my marginal rate of tax. So if I put in 10,000 into my AVC, revenue will give me back 4,000, and I can do it again for this year. And obviously, look, there's maximums that revenue will allow, so we can look at them on an individual basis. For young people, I suppose, starting off paying into AVCs, I always think any type of retirement planning is a little bit like planting a tree. You know, if you said to somebody, look, when's the best time? I should have planted my tree. It's 30 years ago, because you'd have a proper tree now. Whereas if you're saying, look, when is the best time to plant a tree? Well, look, if you haven't planted your tree already, now is the best time to do it. So make sure it's affordable for you and it fits in with your lifestyle and it fits in with your finances. But definitely start something, because it's, you know, look, we'll go into the tax, but it's fully tax deductible at your marginal rate. So contributions are tax deductible at either 20 or 40%. And I have an example coming up shortly. While you're paying into your ABCs, they're growing in a dirt tax-free environment. So you're not paying any dirt tax on any accumulation that the fund makes through either compounding interest or growth on the fund. So on top of the tax relief you're getting from revenue, it's also, you're not paying any dirt tax on the accumulation. When you get to retirement, you can use your ABC to either supplement your pension. So some of you might say, well, look, I've left things a little bit late, so I just want to boost the tax-free lump sum and bridge the gap, potentially a 6-year gap between my main scheme pension and the contributory state pension. You can pretty much do, if you have the time on your side and you have the affordability, you can build up a pot of money in your ABC to supplement your main scheme benefits. But the first thing that I would advise anybody to do is to maximize their tax-free lump sum. Okay. If you have left planting your tree to the last minute, which I hope you haven't, but if you have, and you're considering a last minute AVC, basically what that is setting up an AVC to boost your tax-free lump sum just before you retire. So when I say that, you could do it a week before you retire, or you could do it a year. Nothing sets my heart racing like somebody trying to set up an AVC a week before they're due to retire. So look, it's not an ideal situation, but if you are short in your tax-free lump sum, don't walk out the door and leave that money behind. It's completely free of tax to boost that lump sum up to a maximum of 1.5 times your salary. Now, obviously, look, there's caveats to that. You have to have more than 20 years of service to do that. But again, I can discuss that with you on a one-to-one basis. So when it comes to AVCs, you're going to be faced with two different choices. There's going to be the group AVC, which is set up through your employer. It might be union sponsored, and it'll certainly be deducted through your salary. Or you can set up a private AVC that you take out yourself with a provider of your choice. And that's really where I come in. That's where I'm going to be advising you on what is the best fit for you, because the group AVC schemes tend to be the default way of people setting up their AVCs, because it's done through payroll and because it's just easy. But in many cases, the group AVC is a very expensive way of setting up your AVC. They charge an initial setup fee, or they can charge a deduction from your AVC contributions up to as much as 30% of your fortnightly AVC contribution may be taken in charges. And for a lot of people that I talk to, they do not know that 30% of their contributions are being taken in charges, or indeed that there's a setup fee. On top of those fees, you're potentially paying another percentage in charges every month thereafter. And every time you top up your AVC, you're potentially back to the 30% charge. Now, it's not in all cases, but it's important that you look at your AVC. I'll be able to tell you pretty quickly what type of AVC that you're on and if you're paying these type of charges. Because bear in mind, it can mean the difference of thousands in your pension pot when you come to retirement. And there's no point in finding out at 60 or 65 that you've been on the wrong type of AVC. So the PRSA AVC is done by a direct debit through your bank account. Tax relief is exactly the same on both of them. The only difference is that you're getting 100% of your AVC contribution going into the pot. There's no setup fees. There's no reduction in your contribution for, your financial advice. It's 100% of your contribution going in. So I know which AVC I would prefer to be in personally. But again, that's something that I can go through with you in the consultation and advise you what's the right fit for you. If your ABC scheme is not set up on one of these, costly packages, I'll be able to tell you quite quickly, and then there's no need to make any changes to it.
Ruth, I'm just going to be rude here and say it's coming up on quarter two. So
Yeah.
we said, guys, we were going to run for 45 minutes. If you're comfortable, we'll keep going because it is important. This is very, very good stuff and it's very important. But Ruth, if you can, don't be trying to distill all your knowledge now because
Oh,
we'll be here to 10 o'clock.
I'll hold some of it back, Pascal. So look, I've been told to move on, so I better move on. So look, just very quickly, if you do have an ABC scheme in place and you regret your decision not to buy years of service, you can do that through the ABC at retirement. So with your ABC, when you get to retirement, again, it's not something I'm going to spend a lot of time on because, we'll discuss that when you get to retirement. But you can basically buy a guaranteed income for life. You can transfer your ABC to an approved retirement fund, which allows you to keep your ABC invested and to be able to control your tax in retirement. And then you can take a taxable lump sum, which obviously is not the best approach because you pay back the tax that you saved while funding into it. So not the best approach. So the tax benefits of the ABC very quickly, because Pascal's giving me daggers here. So look, just to give you a quick example of somebody putting in 500 euros, and it's just an example. 500 euros a month, if you're on the higher rate of tax, it tracks 40% tax relief. So in other words, I'm putting in 500 into my ABC. Bear in mind, if you're on the PRSA ABC, 100% of that 500 is going into your pot. 200 euros is tax relief at source. So you're getting 300 euros back. Excuse me, it's costing you 300 euros, you're getting 200 back. So to save 500 euros per month, it's costing you 300 euros. After 15 years, you should have built up a nice pot of money there for yourself in your ABC, which has only cost you 54,000 euros. So if you compare that to a credit union or a bank or wherever you're currently saving, just by redirecting 300 euros of your savings, you're actually up 36,000 euros in tax. Over 50, you've saved an additional 36,000 euros just by redirecting your savings. So look, it's definitely worthwhile for you to look into these AVCs, if not to boost your retirement income, certainly as a different way of saving. And it's an excellent tax efficient way of saving for retirement. So the private consultations, Pascal, you'd be delighted to hear this is my last slide. So the private consultations, what we cover in the consultations is a tailored breakdown for you of what you can expect. Because tonight was just, as I said, just general information, a tailored breakdown of what you can expect from your employer through your pension and your lump sum. And if you have pensions from previous employers, by all means, we look at them, explain to you how that they will tie into your retirement pots, how they can be drawn down, and more importantly, should you be leaving them with a previous employer or should you be looking to transfer them out into a private pension, a private pot for yourself? So look, obviously this private consultation is for you. So establish your goals and concerns. So you're going to be really telling me, look, what your goals are, what your lifestyle is that you want to continue into retirement, and what securities you want there for your financial dependents and their aspirations for them. Obviously, look, if there's gaps in your finances currently or any areas that I feel that you should be addressing, I will point them out to you. I will definitely point out anything that I think that you should be looking at and prioritizing now. And that includes if you should have the income protection in place, if you do need additional life assurance, I will be pointing that out to you, okay? And look, there's no point in doing a financial review with myself or Pascal and then swanning off into the sunset and never reviewing it again. It's important to make sure your plan remains aligned with your changes and obviously market conditions. So it's something that we would review regularly with you. So for me, that's it. Thanks a million for listening. Obviously, we'll go through questions now, Pascal, if I haven't taken up all of your time.
Well, it's not my time, Ruth, at all. I can wait here, but not everybody can. But guys, again, listen, Ruth is a brilliant asset, and we are absolutely delighted to have her to provide this value-added service to you, the public sector. Use us, guys. We're here. Ruth is prepared to give you top-notch advice that you won't get anywhere else. So use this, guys. Make an appointment with Ruth and have a chat with her. Give our office a ring, and we're more than happy to arrange it. Okay, some questions. If I take a career break for 1 year from teaching, is it a good idea to buy back years? And how much would it cost to buy back? Ruth, do you want to field that one?
I would personally say buying back years of service are not as attractive for anyone that's on the post 1995 scheme because of this introduction, or excuse me, integration with the contributory state pension. So you're buying back a reduced benefit because it's integrated with the state. I would personally say an AVC might suit that person better because what they can do is they can build up a pot of money for themselves and then decide closer to retirement if they want to buy that year back through their AVC.
Okay. Income protection. There's group types that cut out cases after 2 years. Cut out. That cuts out ceases after 2 years. Income protection, there's group types that cut out ceases after 2 years. Not quite sure what that means. There are some income protections available in the marketplace, guys, where you'll only be able to claim for 2 years in any one claim. There are a couple of those out. It does keep the cost of the income protection down. Now, whether they're a good idea or not, you'd need to take financial advice on that one. But they are out there and they do keep the cost down. But it is important to remain that it is only a claim for 2 years possible per claim. So, question from Bernadette: how long do you have to be on a final salary? As you mentioned, 3 years. What is going up from 4 days to 5 days? Working week a year before retirement. So I think the question is, if you go from 4 to 5 years or days a week, does it help?
Not particularly, no. So I think I possibly may have confused people there. So the 3 years before retirement is in relation to a promotion. So if you're going for a promotion, don't do it a year or two out from retirement. Do it 3 years out because then they'll use the higher salary for your pension and lump sum calculations. But if you're currently working a 4 day week and you decide to go up to a 5 day week a year before retirement, you're not really making a massive impact on your pension because the calculations will be done on your full-time equivalent salary, regardless of you working a 4 day week. So you're only getting like 1 day a week extra on top of your service that you've already accrued.
Okay. Another question. Professional added years cannot be applied for until 3 months of your retirement. Is this the case?
No. So professional added years of service are either awarded based on your grade or they're not. It's not something that is awarded to you 3 months out from retirement. You will be told on your contract whether professional added years apply to you. But as I said, for post 2013 entrants, they're not applicable. They don't exist anymore.
So I presume
Um,
anybody that is a professional in inverted commas knows that they are.
well, look, you're looking at, the likes of engineers, architects, psychiatric nurses only have to work 30 years to retire with full service. So there's, you
What about
know,
radiographers and all these type of people? Where do they fit?
no,
Okay.
no.
So it's important for people to figure out whether they fall under that, and I say it professional in inverted commas because you all are professional, but whether you actually fall
Absolutely.
under that bracket or not, obviously your employer has to be able to tell you that.
I'll be
So,
able to, if people want to ask that question in the one-to-one consultations, I'll be
okay,
able to find out for them,
brilliant.
if they're
Well
entitled
done.
to them. Yeah.
Okay, Anthony, good question. How do I get a private consultation? Anthony, we charge you an absolute fortune, and we'll move in with you. I'm only joking. Give us a call, guys. I'm going to circulate a questionnaire after the meeting, and it'll probably be tomorrow. And it's just a link that you can actually fill in your information, tell us what you want to talk about, and we'll be in touch to arrange an appointment with you. For anyone that's on the call, you're entitled, the fact that you've taken the time to be on the webinar with us, you're entitled to a consultation with us. I would encourage you to speak with Ruth, to be honest, because Ruth's the expert. I've been doing it, but Ruth is the real expert, guys. She's been doing this exclusively for over 20 years. So get a consultation with Ruth. She's the person to really do this for you. So a question, income protection is tax deductible. Do I claim the tax back myself each year or can it be deducted at source automatically?
Is this on the private AVC rather than go down the group route?
I think that's probably the question, yeah. And
Yeah. So sorry, Pascal.
go ahead. Go
So
ahead.
with regards to the tax relief, if you decide to do not go down the default group ABC route, you can go down, you can take out a private ABC. And as I said, I'll be able to advise you because I'm not tied to any one particular company. So I'm not tied to the group schemes tend to be tied to either New Ireland or Irish Life. I'm not tied to any of them, so I'd be looking out for the best one, the best fit for you. Tax relief on your contribution is done when the ABC is set up from the outset,
Yeah, we're
and
talking we're
I can
talking
do.
about we're talking about income protection now.
Oh, income protection.
Yeah,
So
yeah.
income protection, tax relief is pretty much the same. I can either apply for it for you through your revenue account or
Hmm.
you can do it yourself. But either way, I'll walk you through exactly how to do it. And it's
Perfect.
applied through your take-home pay. So it's granted straight through your payroll department.
Okay. So another question: can you buy back temporary years in the single scheme?
Um, yeah, so for anyone that worked on a temporary capacity, yes, they can still buy back their temporary years of service. It generally applies to the HSE more so, nurses and people that came in on temporary or student years.
Okay. Was mortgages covered? Apologies, missed the start. Well, you missed the mortgages. We had a great session on mortgages, but unfortunately, you missed it because you were late. I'm only joking. No, we didn't. There's lots and lots of stuff, guys, that we didn't touch on. We didn't touch on mortgages. We didn't touch on seniors' equity release. There's lots of financial advice that we can give, but obviously, in a session like this, we have to restrict it. So we will be doing other sessions in terms of mortgages and seniors' equity release. So keep an eye out, and we can certainly keep you updated. If you want to talk about mortgages, by all means, give us a shout back, and we're more than happy to have a consultation, and we'll take you through the mortgages. Okay, questions, chat. Okay, 2 seconds. We have loads and loads and loads of questions. Okay, guys. Okay, so if it's a career break from 1 year teaching, we got that one. Hi there. Thank you for the information. Do you know if are unmarried and children when you retire, is there any way of claiming back the spouses and children? Great question, Karen. Can you basically, if you're married and don't have any kids, can you claim back the money that you paid for it over the years? No, I guess is the answer.
The spouses and children, it's a bit funny that scheme because okay. So if let's say you retired at 65, you can get married at any time. So you can never claim back the spouses portion of the spouses and children scheme. But funnily enough, I actually have heard of women being able to claim back the children's portion because obviously, at a certain time in a woman's life, she can no longer have children. But a man cannot claim back the children's portion of the spouses and children's
Well,
because
that's just
they can
that's just a
go,
bit sexist, that isn't it? There
they,
you go.
they can have kids whenever they want.
Okay, so can you buy back temporary years of service? We answered that one. That's fine. Is there a tax-free lump sum linked to service 1.5 times salary? Yes, there is, and it is 1.5 times your salary. So yeah.
With
Uh,
with full 40 years of service.
with full 40 year service. And if you're short in service, back to Ruth, AVCs can branch the difference there, guys. So
Exactly, yeah.
thank you, Ruth and Pat. Very informative. Thanks, Mary. Great presentation. Thank you. Thank you. UK pension, any info?
The UK pension to make contributions, is it for the national
To
insurance?
be honest, I don't know. It's just any info. Actually, we would need more info to be able to offer you info, is kind of the answer I'll tell you there. We
Yeah,
can
if,
we can
if people
certainly give
just
you.
very quickly, if people are looking to make national insurance contributions, there's a deadline of April 15th, but I'd certainly have information on it and give you kind of point you in the right direction, but you're kind of running out of time now if that's what you're looking to do.
If that is, guys, if it's a question of I have a UK pension and what can I do with it, you can bring it into Ireland and we can certainly help you do that as well. It's done through what I call a CURARPS. It's a particular pension in Ireland that you have to bring it under. Ruth and I can definitely help you with that one if that's where you're going. Your question's a bit vague, but thanks for the question, Sharon. Fantastic presentation. Where and how do you make a consultation? Nolene, you'll get information on how you do that, but you can ring our office number is 074 910 3938, and you can get the office number and the girls there will be able to help you with Ruth to do that. Helen, thanks. Referent high duty allowance and pensions, if haven't got it in 3 years, e.g., have it for
Oh,
two now, is it treated the same for pension purposes?
I think I know what that person. I hope I don't go off on a completely different tangent. But just to clarify, with regards to salary, your employer will use your best salary. And so your final salary, if your final salary is not your best salary, it's your best salary over the last 5 years. If it if it's better for you to go back 10 years, they'll use the last 36 consecutive months over a 10-year period. So if, let's say, going back 10 years and looking at 36 consecutive months works out better for you, your employer will do that.
Mary, here's the advice. Get advice. Talk to us, Mary, because it is important. And the difference there can be huge, especially when it comes to your tax-free amount. So
Exactly, yeah.
between what your employer will actually give you and what revenue allow, there can be a substantial gap there. So things like AVCs can make up the difference there quite a lot. So really is important to take advice.
Can I just say something there, Pascal, very quickly? And I know you're
No,
eager
no,
to get
I'm all
people
right.
finished. There's a West Ham match on at 8 o'clock if anybody's a West Ham fan.
Ruth,
Um,
Ruth, we're not here for the football. Come on.
just with regards to people's pay, which is really important to note, and I see it all the time. People have, let's say, a salary, a basic salary, and then you see people with Saturday allowance. They might work night shift. They might get, unsocial hours. It's so important for you to note on your payslip what is pensionable, because although your salary might be 50,000, your earnings might be 70, but only 50,000 is pensionable. So the AVCs are really going to help somebody there boost their tax-free lump sum based on the 70, whereas your employer is only going to give you benefits on the 50.
So guys, I've one other question, and we're going to end with a couple of points up after this. So, is this webinar available for recording? Yes, we are recording this. It will be available. I do have a YouTube channel. I didn't know I had a YouTube channel. Apparently, my social media people
Look
tell
at
me I do.
you.
So we do have a YouTube channel. We will make it available. You will be getting communications from us over the next couple of days. For anybody that has attended, absolutely, we'll send you a link to this. For the people that have registered and haven't had an opportunity to join us live, they'll get access to this as well. Guys, we run these sessions at least monthly. It's not always about public sector. It might be about mortgages. It might be about savings, about investments. And the whole idea of what we're trying to do is give people to professional advice when the time that suits them in the comfort of their own home. And the best advice Ruth and I can give you is to seek advice. Seek advice from a non-biased advisor that is not there to sell you anything. We're not actually here to foot in the door salespeople. We're here to offer advice. And that's where we think education allows you to make informed choices, informed financial decisions. And that's what we're all about. So guys, get in touch. More than happy to have a chat with you and meet with you on a one-to-one basis and give you your advice, not just general advice. So thanks for joining us. Ruth, great presentation. Thanks for that.
Thank you.
Chat soon, guys. Take care. Bye for now.
Thanks, everybody. Bye-bye.